Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Dave Donovan, Executive Vice President of Financial Services at Publicis Sapient, to discuss how businesses, particularly banks, can proactively address high-risk borrowers to avoid massive defaults. And the key to this is centered around data and technology. Dave, welcome back to Trade Talks. It's great to have you with us.
Thank you, Jill. Thanks for having me on again.
And you've been on Trade Talks with me a number of times, and we always come back to the digitization of the banking industry. COVID-19 has certainly accelerated that trend. How can the financial industry leverage data and technology to model credit risk?
So I think what we have now in the marketplace is we have between emerging technologies with cloud and AI, as well as very rich alternative data sets, there's an opportunity for banks to be more proactive in identifying credit risk. So for example, today, even you saw today with some of the bank earnings with JP Morgan, Citigroup, and Wells Fargo, the biggest, elephant in the room, for lack of a better term, was the loan loss provision that all three of those banks had to take. And it just goes to show you the impact of what COVID is doing to these banks. If you look at JP Morgan, they had a phenomenal quarter, but because of the uncertainty of how much credit loss they have to reserve, they're taking a big reserve, and I think they're doing this because they just don't really know what they're totally looking at right now.
Why is it critical for banks and Fortune 500 companies to pay attention to credit risk?
So, I mean, as you've seen with the consumer, and banks are certainly very tethered to the consumer as a large, driver of the economy. Many people have lost their jobs because of COVID, because there's been such a disruption within business. And ultimately, those are the bank's clients, whether it be with credit cards, mortgages, car payments, what have you. And the biggest risk right now is, how are these people going to pay their bills? And that's why you're seeing such focus on loan loss reserve. We didn't even get into the commercial side of the business, but one other data point around commercial real estate, where everybody's proximate now. What is that going to do for the commercial real estate business? Are people going to actually go back to being in large skyscrapers and being in business? Our commercial, is there going to be a need for as much commercial real estate as there has been in the past? And those are very highly levered as well, with a lot of debt that underpins those buildings. So again, just a lot of uncertainty. That said, and that's why I think banks would be smart to start to be proactive, using data, using AI, to try to be more predictive as best they can. And I'm not saying it's easy, but there are areas where they can identify potential credit risks that could be bubbling up in the future by using data and AI.
Yeah, and you make a great point about the commercial side of it. We're not going to know what that looks like for a number of quarters. This isn't going to change overnight as businesses evaluate what their workforce is going to look like, their existing workforce, and what that might look like going forward. Now, what about liquidity management?
Yeah, so quickly, just one comment on the commercials, what you said about commercial, which is interesting. Jamie Dimon said today, he said, we're not even going to know, this isn't even the recession part yet. We're not even going to know what the effects of the recession are yet, because COVID is still raging. So I think you make a great point on the commercial real estate. We're not even going to know for a couple quarters. As far as liquidity management is concerned, so as we've talked about, consumers are under a lot of duress right now, whether they're employed or whether they're not employed. They have to be thinking about, how do they pay their bills? And as we know, 40% of our economy is what we would call a gig economy, where they're getting paid and they live, essentially paycheck to paycheck. And they might get paid on a Friday, but if their account is with a traditional bank, those funds might not hit their bank for a couple of days after they're deposited, which, depending on when their bills are due, they could incur late fees. So one of the things that I've seen that's very interesting is you have these new FinTechs that are in the marketplace now, that that apply liquidity management, where they'll front the money that that a person makes in their paycheck a couple of days ahead of time, so they have that instant liquidity to be able to pay their bills. Because we're talking about people that really, when you're living check to check, you don't want to avoid a late fee because you were waiting for your money to clear so you could pay your utility bill or your cable or your mobile bill. So I find this to be a very helpful service, and one that should be adopted by whether it be big banks or whether the fintechs operate separately. I think it's a great service for the gig economy and for others that need that liquidity instantly.
Yeah, Dave, you would think in today's day and age, and we've learned so much about technology and the trends that have been accelerated as a result of the pandemic, that it's kind of crazy to think that you still have to wait a number of days from your banks to release the funds. We certainly have the technology to make that happen. My final question to you is, how are banks working with fintech companies as they undergo this legacy transformation, not even just in the liquidity department, but overall?
So I think banks are starting to work with fintechs, which is great. And I think a great proxy, when I used to work on a trading desk, we used to say the tape doesn't lie. And when you look out at some of the new fintech companies that are public, and what I'm talking about are companies like Square and PayPal. You've seen their market caps accelerate in a very volatile market right now. PayPal and Square, I think, are just behind Goldman Sachs from a market cap perspective, which would be unheard of in any other time. But it gives you a perspective of what investors see as they look out over the next 2 to 3 years, where they look at the companies that are really leveraging technology and being able to apply funds in real time, being able to give consumers that visibility to their financial health. So for me, what we try to do at Publicis Sapient is certainly try to consult and help some of the bigger banks move forward and adopt some of that digital technology so that they can be even more impactful in consumers' lives going forward.
All right, Dave, great to have you with us. Thanks for joining me on Trade Talks.
Thank you, Jill. Have a great day.
Thanks, you too, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.